Hey, welcome back everyone. So my name is Zach Vines, and in the previous video, the accounting equation slash debit credit tutorial video, you have your initial exposure to what it increases and decreases the various accounts in the accounting equation. So just kind of as a brief overview of that, we have the accounting equation right here where your assets equal your liabilities plus your stockholders' equity. And debits will increase your assets, credits will decrease your assets. Simply flip that logic on the right side. And then when we're dealing with your net income, so we have your revenue minus your expenses equals your net income, the revenues will behave similarly to the right side of the equation where it holds a credit balance. A credit will increase it, where a debit will decrease it, whereas the expenses act like the assets, where a debit increases and a credit decreases. So the logic behind that was kind of explained in the last video. So if you're still struggling with that, I suggest that you go back to that one and kind of look back through it one more time. But that's just sort of your initial exposure to what increases and decreases those accounts. But you actually have to apply those to specific transactions. You know, that's really just kind of the bare bones framework that you're going to use to solve most of the problems as you're beginning your fundamentals of accounting classes. So now I'm going to show you pretty much the logic that is implied in a lot of our heads when we start getting more well-versed in accounting. We're debiting, we're crediting, journal entries, no problem whatsoever. When you're first getting started, it can kind of be tricky to find out exactly where to start with it though. Like, what do I need to pick out of this problem so that I can actually debit and credit these transactions accordingly? And so I'm basically breaking out that implied rule of thumb a lot of us already have in our head on how to debit and credit so that you can read through it, follow those steps, and over time you won't have to follow, oh, step one, do this, step two, do this. It will become an implied rule of thumb that you can just do over and over again. But this should be very helpful as you're very beginning your accounting classes. And so the first thing I like to ask is what accounts are involved here. So you have a problem, you see a series of transactions. We're going to go through a couple right here in just a moment. But the first step I like to look at is go, okay, I have a transaction here. What are the accounts I even have to debit and credit, right? Like, you can know that debits increase assets and credits decrease assets and so on and so forth, and that entire map that you have laid out for you. But until you know what accounts are involved in that transaction, you don't even know what to debit and credit, let alone how to apply this rule of thumb to those accounts. And so the first thing I like to do is to identify what accounts are actually involved here. The next thing I ask is, did those accounts increase or decrease? And so much of this is going to be very case by case, and you'll kind of have to figure it out as you go along. But to find out whether those accounts increase or decrease, sometimes it's very obvious, sometimes it's not. Again, we'll go into that example in just a moment. But then you ask yourself, once you know what the accounts are, and then whether those accounts increased or decreased, you simply ask yourself, what types of accounts are they? And there are certain rules of thumb you can follow, like, for instance, receivables are always going to be assets. Payables are liabilities. You have things like cash and equipment and inventory. Those are going to be things like assets. And as you go along, you're going to start to develop those rules of thumb and be able to hold those in your head and not get too confused on them. But in the previous video as well, when we were going over kind of what was the definition of an asset, what was the definition of a liability, if you apply those definitions to each of these situations, it shouldn't be too terribly difficult to identify exactly what's an asset, what's a liability, what goes under stockholders' equity. But a lot of that will be case by case as well. But once you identify what types of accounts they are, you simply match it to this map that we have laid out and just journalize it accordingly. So without further ado, let's go ahead and get into an example here where, let's just say we pay cash for a service, okay? So let's say I want someone to mow my lawn, all right? And I'm not necessarily going to debit and credit my own little personal journal entry. I'm not a company doing that, but just kind of for demonstration purposes, I'm paying someone to mow my lawn, right? Well, if I'm paying them cold, hard cash, cash is involved, right? So let's do step one. What accounts are involved? Well, cash is involved because cash is physically going out the door, right? Like, I am giving him green dollar bills so that he's going to mow my lawn. So cash is certainly involved. And for me, if I'm paying cash out and I'm recognizing a service someone has performed for me and I'm receiving the benefits from that service, that's going to be deemed an expense, okay? So to start off with, kind of question one right here, what accounts are involved? Well, that's going to be cash, and an expense, we'll call it service expense, okay? Okay, so that's step one, is just to identify what accounts are involved in the first place. Now, did those accounts increase or decrease? Step two. Well, if I'm paying cash out, cash is going out the door, I have less cash than I did before, right? So cash is certainly going to go down. And then if I'm recognizing an expense, I'm incurring an expense, I'm increasing the balance in my expense account. So my service expense is going to increase as well, okay? So step one, what accounts are involved? Cash and service expense. Did those accounts increase or decrease? Well, the cash decreased because cash went out the door, and expense increased because I recognized an expense. So what types of accounts are they? Well, cash, that's pretty much the quintessential asset, right? That's the first asset you learn about. It's, assets tend to be things that you can convert into cash oftentimes. Like the more liquid they are, the more current they are, you can convert them into cash. Cash is already cash. That's about as current as you get. So that's certainly going to be an asset. So I'll go ahead and say that's an asset right here. Okay. And then a service expense, what type of account is that? Well, it's probably an expense, right? Expense is an expense, so that was pretty easy. So we'll call that an expense. Okay? So at that point, you just have to map it out to your map. So cash decreased. So that's an asset, right? What decreases an asset? A credit. So I am going to credit cash. So we have a debit here and a credit here for some amount. Okay, so in this case, I never came up with a number. Let's say I paid cash for service. I paid you 50 bucks to mow my lawn. So we'll go ahead and put $50 here and $50 here. Okay, and then so like I was saying, with the cash decreasing, that's an asset credit. So I'm going to credit cash because cash went down. And then an expense, well, I increased the balance in my expense account, right? Well, expenses increase with a debit. So I'm going to debit expense. And we'll say service expense. And you're done. So over time, as you're beginning to go through these problems over and over again, you won't have to go through these exact steps in your head, but it helps to kind of have that rule of thumb as you're beginning to learn it in the first place. Okay, so for the second example, what's going on here is that we sold something on account. Okay, so what that means is that somebody didn't pay us cash for a service or a product, but we either provided a service, we sold the product, and we basically put it on their tab, right? They didn't give us cash. We go, okay, well, I expect to receive this amount from you in cash at some point in the future. You pay me the cash and we'll just square that away. But for right now, I'll recognize my revenue, you recognize your expense, we'll just square away the cash later, okay? So what's going on right here is that they finally gave me the cash, and so now I can remove that from my receivable and now recognize my cash. And so what's going on here is we're just gonna follow these steps again. So if they're giving me the cash so I can pay off my accounts receivable, what accounts are involved here? Well, I just received cash from the customer, right? They're paying off their receivable. So I had cash come in the door. Cash is going to be involved. So I'll go ahead and say cash will be involved. And then we're paying off an accounts receivable, right? So I had something sitting in my accounts receivable account. They gave me cash. I'm now taking that out of accounts receivable. Accounts receivable is certainly going to be the other account that's involved. So we'll go ahead and say that right there, okay? And now we asked, did those accounts increase or decrease, okay? Well, I just got my cash back, right? They had a balance sitting in this account. They haven't paid me the cash yet, and then they show back up and go, hey, here's that cash we owed you. I go, okay, cool. So I get my cash. It certainly increased, okay? And then in my accounts receivable, it was sitting in a balance waiting for that cash to come in the door. Once that cash comes in the door, I go, I don't expect to receive that amount of cash anymore. I've received it. So it's not receivable, it's received. So I'm going to reduce the balance in my receivable. So I say it will go down, okay? And then we ask ourselves, all right, what types of accounts are they? Well, cash, again, that's the quintessential asset. So we'll go ahead and call that an asset. So we can apply that rule of thumb in just a moment. And then accounts receivable, what did I just say earlier? Receivables tend to be assets. Payables tend to be liabilities, right? So asset is going to be the accounts receivable for sure. We got an asset right there. And then we're just going to apply our rule of thumb. So we have the match to map and generalize accordingly. Well, we're going to match this to the map. We have an asset, cash, that increased. How do I increase an asset? I debit it. So I'm going to debit cash right here. So debit cash for $500, okay? And then we have accounts receivable right here. The balance in that account decreased. It is an asset. How do I decrease an asset? It's with a credit, okay? So I debit cash and I credit accounts receivable for that same amount. And notice this is going to be an asset exchange right here, right? So one thing you always have to keep in mind is that when you're debiting and crediting these various accounts, you want to make sure that your accounting equation still balances out, right? Because your assets equal your liabilities plus your stockholders' equity. So let's actually check that with both of these to kind of wrap up the video. So if I'm paying cash for a service, right? So cash, that went down, correct? We said that cash went down right here. So my asset balance just decreased, okay? So we're in balance to start with, and then if we're just looking at the cash component, assets went down. So what's going on right now is that the asset side is lower, so I either have to increase my asset side back up so it's an asset exchange, or decrease the right side of it so they're both down and now equal to one another. Well, what did I do right here? I debited service expense. Well, an expense, and we can go back to the previous video as well to kind of see how an expense will end up correlating to your stockholders' equity, but essentially expenses, when you increase them, that decreases your net income, right? You have more expense, so you have less income. When your net income is lower, that corresponds to your retained earnings, which is underneath your stockholders' equity. So in the long run, expenses end up decreasing your stockholders' equity. So our assets decreased because cash went out the door, and our stockholders' equity decreased because we recognize an associated expense. So we're both low, and now we're equal to one another. And one more thing with that asset exchange. We increase the balance in our asset account, right? The cash account, the cash asset. So if we're just looking at that component of it, here's our accounting equation. The assets increased because of that cash right there. Well, our accounts receivable, which is also an asset, decreased. So it's like we had a sitting balance in our asset account. Cash went up, so it's higher than the original balance. And then it went right back down by the exact same amount because we increased it from the cash, decreased it right back down through the accounts receivable, and that's just known as an asset exchange because you're at a net effect of 0 and you're still balanced out when you do that. So like I said before, there are so many, pretty much unlimited number of transactions we could go through, and this is a really good kind of map to follow as you're beginning to learn your first journal entries and you're beginning your first fundamentals of accounting class. But over time, this is going to become very implied. You don't even have to match this exactly how I did, but I hope that helps out. And if you follow these rules of thumb as you're beginning out, over time it'll become perfectly implied, and this should help out very much.